Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for December 19th, 2022. We're recording this at 1 p.m. Eastern Time, and this is episode number 371. My name is David Kosmeter. I'm the creator of TimingResearch.com, and you should be seeing my screen right now. And I have, for our guests today, I have arranged for Michael Katz and Leslie Jouflas to join us again. And the option professor is back to moderate. So I'm going to go ahead and turn it over to him.
Okay, great, David. And thanks a lot to everybody for being here. This is a Christmas week we've got here, so it'll be interesting to see how they move these markets. So far today, the dollar and gold are fairly flat, but we're getting activity in the Treasury bond yield and in the stock indexes and in crude oil. So we'll have to see what's going on. Before we get started, let's introduce everybody. Leslie, you want to start out and introduce yourself and your company?
Sure. Hi. Good morning, everyone. It's morning where I am. I'm Leslie Jouflas, and my website is Trading Live Online. I'm a chartered market technician. I've been in the financial markets for over 25 years, developing trading programs and helping traders to do the same.
Sounds great. And Michael, again, introduce yourself if you would and your company.
Yeah, hi guys, I'm Michael. I'm the CEO of Trade a Pool. We are an online prop firm that fund stock day traders. So basically anyone that wanna day trade stocks in the US market can join us, go through an evaluation phase. And from there, if he passes and reach the goal, or she, of course, we get them funded and they trade our own capital.
Okay, great. And of course, you'll get into that a little later in the broadcast where you can explain a little bit more into that. With regards to our starting point, on Mondays, it's time to put up the opening price for the week, which I think is around 38.55 on the SPX cash. So our starting point was 38.55. And the question always is, where will we end up on Friday? And some weeks it's easier than others. I don't think this is going to be an easy week either, but let's start out with Leslie. Where are we going to be? Up, down, sideways? And what is your conviction level?
Well, we've had several down days, pretty heavy down days from last week coming into this week. I'm going to expect a bounce into the end of the week.
Yeah. And how confident do you feel about that?
Well,
50, 70,
can I tell you on Friday?
That kind of... Better than 50-50, but you're not jumping out of your...
I think that the bias is down, but I think it's overdue for a bounce. So I'm going to go with 65%.
Sounds good. And Michael, how do you feel? 38.55 as a starting point, and now we're at Friday. What are we looking at?
Yeah, last week we talked about it, and most of us said that, I believe everyone said that the price would be lower than 39. And I think that we'll continue to the downside, at least for the next 2 days or so, and then bounce up maybe again to those level of the 3,900 on the S&P.
So we could be higher than 38.50 by the end of the week. And how confident are you, basis 50-50 or above or below?
Yeah, a little bit above 50%, I guess, at the 60s. But we'll see about that.
Yeah. All right. Now we've got some of the markets under some pressure here today, and with regards to what you guys are seeing on the S&P, do you have any? Leslie, well, you don't look at the fundamentals except in the paper, but you're
except what you tell me, Jim.
You can't turn off all the news and periodicals and not know any news, but you do focus on the technicals because you're trying to follow the momentum of the money. So what's the momentum of the money telling you right now?
Well, the downside bias, the S&P 500 tried to get through, a longer term trend line starting about a year ago, and the futures popped up through it, but they couldn't close above it. The SPY and the SPX came right to it and got price rejection to the downside. And the price on the S&P using the futures is very close to 50% retracement, which is just around the 38.40 level. It's just tested within a few points of that this morning. But yeah, I agree with Michael that we might see a bounce back up to around that 3,900 level. But I do believe that we'll see the 50% level broken and get down closer to the 618 retracement, which is about 3760-ish.
Now, there was I was watching somebody else doing some charting, and they had two gaps that seemed kind of interesting. One was up near 4,000, and the other one was around 3810. Do you show any gaps at those two numbers at all? And are those possibly going to be a tractor, or what do you think?
Well, yeah, gaps can be
You
like
showing it?
magnets. Yeah, I can see. Yeah, I
Yeah.
definitely see those on the futures. If for traders that are listening, if you just pop on a 60-minute chart of the S&P 500 futures and you take off your Globex data, you're going to be able to see those gaps really clearly, especially the higher gap, the one that had a gap from about just above 4,000 and gap down to an open about 39.76. That's going to be the important gap to watch, in my opinion, because that was right on a 60-minute trend line break. And so I'm expecting resistance at that level. This little shorter gap down here just above 3,900, I think that might be a short-term resistance area on a test, but I think the important one to watch is going to be the one up above a little bit higher.
Yeah, that seems like it too. Michael, anything technical or fundamental or anything that you're looking at that you want to share?
Yeah, as you know, I'm mostly day trading, and
That's
so
right.
not a lot of. I'm not really into the fundamentals. Plus, the market is usually will show you everything you need, at least in my opinion. And there are a lot of paid advertisement in the news, right, on the news. So you got to watch and careful about it. And looking at the S&P, looks to me like again, like a nice momentum to the downside after the bounce up. So let's say if we will continue to the upside going to the 39 area, even a little bit higher than that, 39.25-ish. I believe from that point, we can start pushing down again. And in that case, we will continue probably lower than the 38, probably 37.50. So that's
can you share your? This wouldn't be a bad time to share your screen and kind of walk everybody through an example of what today's action or Friday and today's actions might have indicated on your material on how to get long or short on a day trading type situation.
Yeah,
and maybe
so I'll
give a little insight on how your signals come up and that kind of thing.
Yeah, so I'll give an overview, and then maybe we'll go down to some trades I made today in regarding to that. So just let me know if I'm taking a little bit more time than needed. On the so the S&P on 4 hours. So I'm looking at mostly on a naked chart. I'm using the MACD below. When I'm analyzing the futures, I'm using the indicator, the MACD, as 8, 20, and 8, not the classic one, just with different numbers. And I'm also using the 200 EMA and 420 EMA, 420 EMA. Those are my favorite to work with. Other than that, just trend lines, supply and demand, all of those things. So the market was pretty good, hammering to the downside, now reaching this 420. I actually went long here, and hopefully just to see a bounce all the way to the 200 EMA, but it didn't happen. So what I can expect is basically a bounce up, maybe just another drop to take those stop losses, or just to take other stop losses at this area, because we are reaching a nice support level. So maybe just another drop to the downside, bouncing up all the way to the 39 maybe a little bit higher than that, 39.20-ish. And then from there,
Mm-hmm.
I expect it to fall down again. But we will see how long it will take it. This is a 4H, so it could even be, next week or so. I'm not seeing any Santa rally at the moment, rally Santa Claus at the moment.
You
So
see
that's
the gap around, you see a gap around 38.10, which would mean maybe we go a little bit lower than today's lows, and then maybe if it's turnaround Tuesday, they would pop it after that. Did you see anything that even looks familiar to that?
Yeah,
or?
You know what? I don't see any gaps. I'm looking at the futures. So
Okay.
the mini S&P.
Yeah,
I don't see
I've got
any
it on
gaps
my
here.
charts whenever.
You do?
Yeah,
Okay.
Okay.
I can show it.
When you're sharing, you could point it out. So anyway, it is a situation where if we went down there and filled that gap, and then it started reversing, that could be an area of potential of launch if we're going to get a pop rally. Huh?
Okay, yeah, I got it now. I just dropped the extended hours. So now I see it. Yeah, right here. Yeah, filling this gap at around 37.50. That could be also a nice point to start buying. But again, we are, the momentum is negative, no doubt about it. We broke through channels. We're lower than the EMAs. I mean, the momentum is weak. Nice negative deviation in the MACD. So yeah, the momentum is negative. But you can also, this is what I'm looking for, at least when I'm trading intraday, just looking for the bounce up on stocks mostly. So when price reaching the market reaching support level, I will go long intraday just on a 1 minute chart. Something that definitely to watch for is also the YM, the mini Dow Jones, of course. It's also a great indicator for the market, at least for this time. We saw it most of the time. The Nasdaq was the leader, but then the Dow Jones started to rally, and then the S&P and the Nasdaq pushed also to the upside with it. And right now we are trading lower than the 200 EMA on the YM, the Dow Jones. Again, looking pretty good to push a little bit lower, and then maybe a bounce up.
If you get a buy,
yeah, go ahead. Sorry.
No.
So what I wanted to show you is just some of the trades I made today, just to get the idea of how it looks like. So for example, in stocks, I traded the QQQ, the Nasdaq ETF, and basically when the NQ reached a support level and had a nice positive deviation or diversion in the MACD, and increased volume while reaching the support level, then I started to buy. That was a pretty fast trade, like 20 minutes trade, 30 minutes. So I bought it here at first. Then when it dropped again, broke the $270, that's a round number, psychological number, support level, increased volume coming in at the bottom, added more here, sold at the top of the resistance, added more after a pullback, and sold right here. So this is a classic trade that I will take usually when I see that the market is dropping down. I'm looking for, basically buying the dip, looking for a major support level. I did the same thing on Tesla just before it melted down. So it opened and pushed to the downside, reached a major support level around the 150, bought it twice here. You can see like I don't know if you can see it clearly, but there's like triangle, green triangle, then sold it all the way to the top. So those kind of things I would usually do, and also traded BABA. I love those Chinese stocks. They got great moves. So sold it all the way in this area. Then when it dropped, covered the short. Obviously, I could have made much more, but that's only when looking back.
And then news out of China, they used to used to be mandatory to be locked in your apartment. Now it's voluntary because there's so many people getting sick out there. They don't even want to leave their apartments. Huh?
Yeah, I mean, China is not just about the COVID, but also regulations, and yeah, it's always fun to trade Chinese stock.
Yeah, with regards
Volatility
to as I'm hearing you, it sounds like your entry and exit, or your entry points anyway, sounds a little bit discretionary. In other words, you mentioned MACD and a divergence on that, and you're looking at what other indexes are doing. So, you have a kind of a discretionary way of buying and selling, not particularly automated.
Yeah, you know what? I've been trading for 15 years, so I guess probably about 7 or 8 years, I was very much into automated trading, manually, but very much like a robotic. If you have this, and that, you enter. But as I grew as a trader, I just became more of a discretionary trader because when you have the experience, you just started to see things that you don't when you trade in 2 years or 3 years.
And when you do get into a trade, do you have any standard exit strategy, or are you still working with just a discretionary gut level?
No, I mean, I do have a list of reasons to cover, basically. And as soon as I see that with a discretionary mind, I act upon it. Yeah. Right.
So you don't have any kind of a concrete, I'm going to buy the S&P if it hits, say you just get in for whatever reason you get in. You don't have any kind of physical stop in there, or any type of exact risk you're trying to take on every trade. It's pretty much your own decision making.
I mean, for the stop loss, 99% of the time I'm afraid to say it when we have people listening, but I don't put my stop loss in the system. Maybe someone else is listening, maybe he should or she should, but at least
no, this is just your own method. We're only talking about your methodology, not the entire planet. You know what I mean?
So I don't use, most of the time I don't use a stop loss in the system, and I do have my ways, and like again, the reasons to cover. I'm reaching a resistance level. I see increased volume on resistance level. I see that the market is shifting. So those kind of things that tells me, okay, this is the time that I need to get out of the trade. And as you saw, and basically most of the time I'm entering and exiting the trade, scaling in and scaling out. I won't go full in just with one entry. So this is also something that I really enjoy doing as I continue to grow as a trader, because as soon as you understand that, you manage the trade a little bit different. So you go, let's say you have a daily loss of let's say $100, and you want to risk per trade 30% out of it. So you're risking this $30. You're not go all in and risking on one click $30. You want to enter with $5 risk, and then add in $10 risk and $20 risk until you reach that 30% out of your daily loss that you're willing to lose per trade. Hope it makes sense.
So you do have some type of discipline on how much risk you want to take each trade, each day.
100%. Yeah. 100%.
I'm with you. Yeah. Because obviously risk management is the lifeblood of staying in there.
Yeah, you gotta have it, but as soon as you continue to crafting your trades, you basically start to play with the managing side of the trade. So it's not really necessary to enter the right point at the right time. The exact millisecond or the exact point, the exact price. You can actually play with the trade and manage it. Yeah.
Well, Leslie, I'm going to turn it over to you, and you can put up some stuff that you're looking at, and maybe discuss some of your methodology as far as entry and exits, and give a little idea on your take on how to proceed.
Okay, hang on. Let me get my screen share going here.
Sure.
Okay.
I think it's interesting to hear, the methodology of each person. You know what I mean?
Yeah, I think it is too. There's there's many ways to trade. Um
Right.
e- Even just that one statement encompasses many things, time frames, markets, focusing on one market, focusing on a lot of markets. I'm a discretionary trader, but what I trade is tested, and I use a percent of capital available. I do initiate all of my trades with a set stop loss that's been tested. I tend to I prefer wider stop losses to give the market time to jiggle and wiggle around. I think one basic error newer traders make is using stops that are too close, and that generally is because they're placing their stops out of fear, not out of studying where the correct stop loss should be. And so that's something that I find is something that's fairly easy fix for traders. They just need to do some work on the stop loss. So I generally initiate my trades with a wider stop loss, and then it depends. My exit strategies depend on the specific market conditions that we have, the volatility,
Yeah.
are we in a range? Are we in a trend? And so those are going to dictate the exits on that. But I use pattern recognition. And so this is an example of a pattern. This is the ABCD sell. This is on the SPY. I generally trade futures. So this pattern, I'll give you just a little explanation of what you're looking at here. We're looking at a daily chart of the SPY. This is the trend line that I was referring to. So this goes back to the high of the market from late December, early January. There was an ABCD sell pattern here. It's actually a butterfly pattern because this leg extended above this last swing, and the butterfly pattern is a reversal pattern. Doesn't always get this huge of a move, but it can get powerful moves for sure. So this trend line has been holding really beautifully. There was a little bit of a pop up above that trend line here, but there was no closing. So that's going to be the important thing on a little bit longer term basis are the closes above this trend line. And generally you're going to need at least a couple of closes above it to confirm. And so I don't think we're really going to be in any kind of bullish conditions until all of the indexes get above that trend line. The Dow has been above it, but the Dow has much fewer stocks in it than the other indexes. So we don't have confirmation from the other indexes. So on this rally from the October lows up to these recent highs, it formed an ABCD sell pattern right at that trend line. Now, unfortunately, on the futures, which is what I trade, have the same pattern, but the what's called the completion point, the futures price did not quite get there. And so I had to wait for an entry below back below the trend line again. So let me show you a couple of things what I was talking about. So hopefully this will put things into context. What I'm showing here with this green line, in case you're curious, is these swings tend to be equal in length, and markets make these what we call harmonic moves, and they can make contractions, expansions of what the primary move is. So on the downside, this length is like the primary length I'm seeing on the down swings. So I'm looking for, if on a little bit longer term basis, we break below these lows made in October, then I'm looking for an equal length swing coming into about that 618 retracement using the 2020 lows. So that's why I have these lines marked on the chart, just in case you're wondering what some of those lines are. So that's what those are. So here's the 60-minute chart that I was talking about. So if you take off the overnight trading session and you're just looking at the regular session from open to the regular close, that's going to allow you to see more areas where you can find those gaps. And also, I like to use horizontal lines. Michael had that beautiful upward sloping trend line, the parallel that's broken. But we can also see that there was a big range here that formed. And so this is broken. That's just where that little gap is he was talking about. Might come back up to a little test. And then I would expect also some down move from that. But I've done a measured move target. This is just sort of a rough way to estimate a move. You can take about the height of the pattern. I'm not including this little pop up outside of this range. I'm just including this height and just, cloning it and projecting it to the downside. So somewhere probably between that 618 retracement 37, let's just call it 50, rounded off to about the 3,700-ish level. There is in right between the 786 and 618. I don't keep that one on my chart, but it's the 0.707 Fibonacci ratio. And so this projection is coming into what would be that ratio. And we can see just using my horizontal cursor there, if you follow that across, you can see the support area there. This was a resistance area where the market came back up through. So that price level, you can see previous gaps in that level. So this price level right around this area is an area that the market may find some support for a bounce back up. But for me, in order for this market, again, the daily trend line is important, but on a shorter term time frame for this market to turn really bullish again, this is the gap I was talking about that is more important here. This is the gap that from the failure, this is the first gap to the downside. There was really no attempt by price to get back up into and close that gap. And if the price were able to come back up into this area, it's coming back to about the halfway point of that range. But if it closed this gap, I would have to make an assumption that price is heading up above and breaking the upper resistance area. But I don't have any bullish indications yet on, anything that I'm looking at. The price really has to prove itself on the bullish side right now. There might be some good, Michael showed you some nice counter trend bullish trades that he did this morning. And I think for traders that are shorter term, they're able, if they're nimble enough, to catch some of those. For longer term traders, I think it's a bit of a risk trying to catch some of this downside unless you can kind of monitor any positions fairly closely, because these down moves tend to happen much more swiftly. And they, that's why they call them bear markets. I don't know if everybody knows this, but it's because bears, when they fight, but those big claws, they swipe down, very sharp, swift moves to the downside. And bulls with their horns, they fight with an kind of upward movement. But our down moves are generally much faster than the up moves.
Right.
So
I had a couple of questions for you.
Yeah.
Oh, can I ask you just a couple of things real quick? Yeah.
Of course.
You mentioned about, and I think this is very important, fear with the stop losses. My feeling on when you hear fear of stop, where you put the stops or whatever, it comes down to one of two things. Either A, the capital you're using is not really risk capital, so you're worried about it, or you have too many positions on. So would you say that the fear with the stop losses can come down to either you got to make sure it's risk capital, and B, you are probably trading too many positions?
I think those are two of the elements that can lead to that fear. I think one of the, those are definitely things that lead to that fear. But I think also a really important element is that most traders don't have a written or a tested trade plan. Michael obviously has been in the markets long enough that he knows the price behavior that he's looking for. He knows that, but a trader 1 or 2 years experience are not going to be able to read the markets with that kind of confidence. But a trading plan is what, so Michael's trading plan, he's got it kind of in his head and he knows what he's looking for. Traders should definitely develop a trading plan. That's their guide that guides them through the markets, that tells them how they enter trades, what their trigger is, what their stop loss is, and what their exit plan is. If they do some testing around that trading plan, that's going to build the confidence. And again, they're going to test and know where the stop loss should be. And so that's going to help them deal with that type of fear. I think that's the strongest tool to deal with it.
Yeah. And, even a small amount of contracts, if you get on a nice ride, like we just had over a 200-point move to the downside on the S&P, one E-mini is over 10 grand. So it's not like you can't make any capital by not having big positions on,
No, that's true. And that's absolutely true. And so the position sizing, the position sizing might be different in up markets and down markets because of the different volatility factors that go with that. But there's also, the minis, the e-mini minis, micro minis, and those are a great place for traders to start to be practicing some trading with. Some traders, I remember years ago, if you guys know who Mark Douglas was, he brought us the book Trading in the Zone, which is a great book on the psychology of trading. He's sort of the one that kind of opened up the topic to traders. Before it was a little bit, nobody wanted to discuss it. But he talked about, I think in that book, he talked about a floor trader that was a really great floor trader. And the other traders used to tease him because he only traded one lot and they're all trading, fistfuls of lots. But he outperformed them because that's where his psychology, that's where his mental boundary was with number of contracts. Some traders can scale up to really large numbers. Other traders are going to be in between one lot and somewhere between that. And it's really important to find where that balance is and stay with it, because trying to exceed it or get some help to try and expand it, if it's really a tough thing to get from 1 to 2 to 3 to 5 to 10 to 100, then get some help, somebody that can help monitor and guide someone through that process. It's all very individual.
The other question I had is, oh yeah, I agree 100%. But if you do find yourself, very fearful, those two items I talked about, risk capital and sizing, probably at the root of quite a bit of it.
Yeah, I think so.
But anyway, here's another question I have for you, Leslie, because I think this is very important. I have a long-term chart, like a monthly graph that goes back 20 years on the S&P. I don't know. Do you have a chart that you could put up that looks like that?
Yeah.
And then I use a long-term moving average, maybe a 36 SMA or something like that. And I noticed that in the last 20 years, only like 3 times has it been violated. And every time it's been violated, the market's gotten right back above it, almost like, people are trying to keep the trend going. It happened in 2018 when they did tightening. It happened during COVID. And then recently when we went down to 34.91, it got it. But then we got right back above it again. And that comes in on my work at around 38.60. And so my feeling is that if we can kind of stay above 38.60, maybe 34.91 can hold up. And if we can't stay above that number, and we're not doing it today, if we start really going into the 37s or 36s, that could be a pretty negative thing. Do you show anything on that long-term graph
Well,
that gives you any
yeah,
insight?
just to hang on just a sec. Give me just a second to catch up with you on
Sure.
that.
Because as we enter the new year, some people might want to know where the macro trend looks like, because again, people who bought in and around this moving average in the last 20 years, that's when they really got a pretty good price on things. And everyone's talking recession and everyone's talking all these negative things. And, when everyone talks one way, sometimes it goes the other.
You're
Usually,
talking, yeah, yes, right. Yeah, there's times to take a contrarian view. That's for sure. I'm not sure
I mean, the
we're not there
consensus
yet,
is a big recession. Yeah, the big consensus seems to be recession in the first 6 months and happy days in the last 6 months. And frankly, it could be the reverse.
Well, I'm back just 2010 on my futures chart, but I can use a SPY or SPX chart to go back.
SPX would be the same thing.
Okay,
yeah.
let's
Just
use
so
that.
people can get a big picture on what the flow of the stock market has been. Because when we were up at 4,800, one of the reasons I was negative is it was so far away from the moving average that it's common sense that we're going to have a reversion back to the mean. And then with the Fed hiking, you had the reason, Yeah. So now we're
there were
kind
a
of
lot of
floating
people,
around it, aren't we?
well, reversion to the mean is I think that can be a tough one because markets can always go farther than than you think they can.
But then the probabilities you go with probabilities, and if the probabilities, the higher something gets overbought, doesn't make it less overbought.
Right.
It's just what you want to do with your money. If you don't want to be involved in what we had in 2022, even if you got out 2 months too early, that certainly wouldn't be a negative on the result we had in 2022. You know what I mean?
Right. Okay. So let's walk through what you were just saying on this chart, and so we can point out those levels.
Okay. I was looking at a longer term moving average, and basically seeing that since I showed it since 2003, we basically had been upswinging. So the moving average is rising, and it's still rising. And then basically we penetrated it a couple of times during that 20-year period, but every time we penetrated it, it got right back above it, and the bull market continued.
Okay.
And now we're back around it again,
Okay. Yeah. Now, okay. I don't have a long-term moving average on this. Maybe Michael has one, but yeah, I do know because I have looked at that. I have looked at that chart with that moving average before. And you're absolutely right. It tends to get back above it. And we could almost make, a stationary trend line here with that in lieu of a moving average. But yeah, I don't know. I think that's just a matter of monitoring the price if it breaks through it, and seeing does this stay through it. Amazon has just broken a very long-term trend line, and some of these big tech stocks they just look ugly, and I don't see them coming back anytime soon from what this price action is. And so I think the question is we have such a divergence on the indexes, is we have not seen capitulation in this market yet to the downside. And so the question is tech leading us lower? If we look at a chart like EEM, emerging markets ETF, that had such, in fact, if you don't mind, I'll just pull one up real quick. Hang on, give me just a second. Go to the right little symbol. Okay. I showed you some of the retracements between, the Dow's retracements are much higher than the S&P, and the NASDAQ's really lagging behind. So the NASDAQ had retraced down to the 618, the S&P had retraced to the 0.50, and the Dow had retraced just a little below the 382. But look at the emerging markets. Look at how deep this retracement is from the 2020 low up to this 2021. This is that is markedly deeper than our indexes. So the question that I have in my head is, okay, are we following some of the other global tendencies right now? Is the NASDAQ tech leading us down further? And the Dow's just had sort of this kind of going a different direction than the majority of the stocks. And I kind of tend to think, yeah. And
Yeah.
and again,
It's a
we haven't
limited universe of only 30 stocks too, right?
right. We just have not seen anything we can call capitulation in a bear market, and that's
No.
generally how bear markets end. So
Yeah.
on this EAM chart, this 886 retracement, this is what I call the last chance retracement. It's not a ratio that a lot of people use. I don't after if I talk about it enough, they will, but it's okay. It's a very handy ratio to use. Most traders use a 786 and of course a 618, and they'll use where the 1.0 is. And there's all this space there. But this is what I call the last chance fib ratio. And you see the retracement that came down here. If this retracement breaks, there is a very high chance that the price is going to get at least to this 1.0, and more times than not will break the 1.0 and go down to one of these extensions. So if this breaks, so this is a level, so this is we're looking at a compilation of some of the largest global companies in the world within this ETF. So I think this is giving us some really interesting information. So this level I'm definitely watching here.
Yeah.
And I think if that happens, then the long-term moving average is going to be broken.
Exactly. So the longer we would stay under 3860, that obviously would move the average down. So if we do 37, 36, 35, not only are we going down again, but it could actually be breaking the spirit of the uptrend.
Yeah.
That's been going around since they started easing. With the QT. I mean,
now,
the
and
QE.
if it holds it, great, and we start to get some more bullish indications on some of these other time frames, great. Then, but again, this little trend line right here on the daily chart, everybody can just draw that right in and watch that on their charts. I think that's going to be the one to watch. Yeah, that was a really good point, Jim. That was for a longer term view.
I'll be happy to share
Michael,
my screen as well if possible.
Yeah, Michael, I wanted you to chime in here and take some time also as you go and talk about this, to maybe go into a little bit about how you do the training of the traders, because I know you have your own, shall we say, discretionary gut instinct way of looking at different indicators. I was wondering, do you use that as a model for your training, or do you kind of let the people come up with their own ideas because they're going to be responsible for their own trades?
Yeah, so we give them a lot of tools and a lot of guidance, but at the end we want them to decide which asset to trade on and how to apply the risk management and the strategies. Because I have my own style, but there are many others that can do much better than me, and they will trade different than what I used to. So anything, any trader that want to try it can do that, and if you prove yourself.
I got a question. I got a quick question for you. As far as the markets that they tend to trade, Michael, because you're short-term trading, obviously slippage can be a real big problem in certain markets. In other words, you might say, okay, that trade's not working, I think I'll get out. And if there's slippage and you lose 20 points because of slippage, that can eat away at your capital. So are there some markets that you would generally not trade because of that reason? And are there some that you would because they have better liquidity?
So, I mean, at the moment, we are only trading, our traders only trade the US market. They can trade small cap, mid cap, large cap. Of course, what the guidance that we share with them and the videos and the lessons and all of those things are aiming for high liquidity, as much volume as you can, stocks in play,
right?
Those kind of things, and not going all to low volume. There there of course will be slippage there, and it doesn't make sense.
Yeah, that's. I mean, that slippage could really eat into your capital, in the especially if the market got illiquid and slippage.
Yeah. This time of the year, because we have so much volatility, you can easily trade the market. It's just SPY and Qs will be enough for you.
Yeah,
you don't really need anything other than that. Leslie,
Right.
if possible, I would like to share my screen.
Oh, of course, yes.
Thanks. Just to talk about the long-term analysis a little bit about that. So I'm looking at the S&P, and this is a weekly chart. First of all, we can see the 200 EMA held in perfectly in 2015, 2016. Then at 2018, the Corona, it broke it a little bit, and now we are holding it as well. And this is something, and again, you can, as Leslie showed, you can just mark the level from here and also maybe draw it as a trend line, as a channel, something about here. And when I'm looking at this at the moment, so there's a lot of space to the downside to reach that support level of the channel. And the MACD has already created a positive deviation when it broke the previous low. But what we can expect is maybe a drop to the downside, reaching the support level. The MACD will continue to the downside, but won't break the previous low. So creating
what level is that support level you're talking about? What's a ballpark level there?
It's like 3270-ish.
Oh, okay.
And
so that's a full blown. That would be a full blown maybe capitulation time frame.
Yeah, and it also makes sense because we are reaching the area, the highs before that. So the resistance and the support. So it does make sense that if we'll go down, this should be the level to start buying, or at least analyzing it and understand if you want to join from this point, something like that.
Right.
And yeah, and if the MACD will stay above it, so creating new higher lows, reaching support level should be with high volume coming in. So, most of the times, especially when you start trading, they all tell you that you need high volume when the price is moving higher, right? But at the end, when we're looking at reverse, we want to see high volume coming in at the bottom, like right at the support level. We had the same here, high volume coming in on the 200 EMA. So if we will go down, and this is the point of basically the dip, the last dip, then we should see high volume coming in also around this area. Yeah, so this is what I'm looking at if we're looking for a long-term analysis. You can also
a lot of people might want to know, because we're all technicians, but we also, well, not we all, but some people would like to know some kind of reasoning why it would go down there. And it's really as simple as S&P earnings for next year expected at $2.30. If they were to drop to $2 and they use a 15 PE, 15 times $2 is 3,000. So for those who would like to have a reason why it might go down there, your reason would be that earnings get cut and the PE ratio goes to about 15 because the Fed keeps hiking interest rates, which puts a pinch on PE ratios. That has nothing to do with the technicals, but some people like to hear, some kind of rational reasoning on why it would go down there.
Right, makes sense.
So,
and if you will add on your chart, if you want to add on your chart the 420, the 420 EMA, it held perfectly in during COVID, and again, this will be a nice drop to the downside. But if we will continue to the downside, and this is it's a weekly chart, so it might happen, it might not, and if so, it might take it a little bit time. But yeah, for at least for the scenario. So let's say we will drop down to the downside, holding this support level, bouncing up. If we will bounce up, we should, of course, reach this resistance level. like the support level will become resistant, and also the 200 EMA played perfectly for the last 20 years or so. So it should again act as a resistance as it acted as support. So in this case, and this is again, it's a little bit early to say, but let's say it anyway, reaching resistance level, dropping all the way down to the 420, and from that point, we should see again probably a bounce up first, and then hopefully I'm not scaring anyone.
Now, I was wondering. Well, it is what it is. I mean, a lot of people probably wish they were scared at 4,800 and they wouldn't be going through the year they did. So sometimes giving people what it looks like it might do. In other words, at 4,800, when you're saying it might revert down to 3,800 because it's 1,000 points above where it should be based on the moving average, that sounds far-fetched, and it wasn't so far-fetched 6 months later. Here's two things that I'd like to talk about with both of you guys. We'll start out with Michael first. Crude oil and gold. So do a little analysis on both, because some people are talking about 100, 120 crude, and some people are saying the gold may break out above the 1,800 and get moving. Let's get a viewpoint from Michael and Leslie on those two markets before we run out of time.
Okay,
so Michael, what do you see on crude and gold?
Yeah, so I'm looking at gold on a 4 hours. It broke through this perfectly channel and went up, looking pretty weak at the moment as I see it. Just for just a quick look, you can see that the waves, like the rally, is getting a little bit tighter, a little bit tired. The angle, the number of candles coming in, pushing the price higher. We broke through that resistance level, but couldn't close above it really. Those kind of things, at least for the moment, showing me that it doesn't look pretty good to the upside. In my opinion, maybe dropping again, trying to reach those support level around the 1760s. And from there, we will need to analyze it again. But for me, it's gonna bearish. And
there's a lot of resistance over that 1,800, 1,850 area. So what you're saying is it looks like it's failing a little bit from that area?
Yeah, it will take it a bit until it can break through it, I guess. And price getting weaker. And
how's the crude looking to you?
You know what? I didn't look at the crude for a while, to be honest.
Well, you didn't miss much. It went from went from 95 down to 70. So
just kind of a little bit of sideways, just a tiny drop. Maybe I'll give Leslie the chance to answer that, and I will take a minute to analyze it.
To do a little. Sure.
Yeah.
Leslie, how do you feel about the gold and the crude oil? Maybe on even an intermediate and longer term basis, as opposed to just like Michael was saying, in a very short term basis.
Well, I'm looking at the chart of GLD, and if I could borrow the screen for just a second.
Sure.
Yeah.
We're very generous with it. We were generous with the screen.
You guys are. You are. Thank you. I'm going to show you. I had the exact same chart Michael had. I want to show you that real quick too, but I'll be quick on this. But gold had a nice strong move using GLD off of these lows. It's had a nice rally up here, but right here it's just in the middle of this, back to this big congestion zone right here. I think after a pause, I think gold can make its way higher. I think it's a question of how far down we go. This line here, that's where there's a little gap area right here. If it closed below that, I would be changing my mind on it. But I think if we stay above this area, especially if it stays above the entire gap, like where these lows are here, it just does a little correction down and then starts to move up again. I think we'll see some nice higher prices. So I think it's a little bit in a mixed bag right now, but think if we can just hold that support, I think it'll see some higher prices.
Yeah.
So.
The Fed seems to be trying to wear out everybody. You know, they wear out the bulls in the stocks, and they're probably trying to wear out the bulls in the gold. If they're just trying to, you know, get people a little bit more sanguine about the future, I guess.
Yeah. But this is the,
but
Michael,
anyway,
oh,
yeah.
I just wanted to say, I love that chart Michael put up. A presentation I did just a couple of weeks ago. I had the same, the channels going with it. And for those that use the Fibonacci retracements, just the area he was just talking about, that's where these measured moves are coming in, and the previous support line from 2020. So I mean, I think if we break and things look, you know, like you said, you know, you monitor the price around here, but that could give a nice, very nice buying opportunity if that does occur.
What do you see on the crude, Les?
Okay, let's take a look at crude. Well, if you don't mind, I'll use XLE.
Sure.
Okay. I think some more downside to come before more upside. So this had a big ABCD sell pattern, and then it got a lot of congestion in here. The descending triangle, it's broken it to the downside, tested here. Got a measured move down here around the 0.50. Even if it extends a bit lower, I see lots of support down around this area. So this might be a buying opportunity if it doesn't just blast right through it, right around this 79.5 to 80, a little bit lower at 618. About 76 and 76.5. But I don't think right now, I still think it has more correction to do to the downside. We can pop on to the futures crude real quick and take a look. So the you can see crude made it to that 0.50. This is the resistance line on crude above here. Bullish, more up, staying below it, either goes into a big range, breaking this, and most likely down at least to that 618. I don't see it really bullish right now.
No, everyone's talking about next spring. Yeah. Yeah, I think maybe China going back into their apartments probably didn't help it too much, because, you know, they were kind of counting on a China demand story, which seems to be delayed, at least. You know.
Yeah, I don't know. There's been some, yeah. I mean, I've heard a lot about, you know, of course, inflation, oil, everything that was certainly part of the story early, but I'm still hearing that is part of the story. And I think that's old news. And so I think that, you know, what I'm seeing on the chart, just not seeing anything really bullish right now.
Nothing confirming that.
Yeah.
All right, we're going to be at the top of the hour, Leslie. So why don't we, again, reintroduce ourselves, and also if you have any special offers you'd like to extend, this would be a great time to do it.
Yeah, well, thanks for having me on. It's always fun to do this show. Again, I'm Leslie Jouflas. My website is Trading Live Online, and the website exists to help educate traders and bring them through a process so they can improve their trading. I do have a all course bundle special right now. You'll have to email me though. I do not have it posted on the website. It's only on my email list, but you can look at all the courses. So it's all the courses bundled together. And we're going to follow up with 6 months of online kind of question answer, going to the live charts, putting all that material together starting in January all the way through June. So I'm here to support traders. I don't just tell you a course and disappear. I'm accessible, and my goal is to help you become a better trader. And that's a path that can take a little time to find sometimes. So I help you find that path.
Sounds great, Leslie. And Michael, could you reintroduce yourself and the firm again, and a little bit of any special offer you want to extend?
Yeah, so basically we call Trade a Pool. It's our TTP in short, and we fund stock day traders. So any trader, even if you're a 1 month trader or a 15 years trader, you can try our evaluation phase. You pay a fee of around $300, and we test you in case you make it and reach the goal, not reaching the maximum drawdown, reaching the profit that the program objectives for in the program. Then you get funded and you start trading on our capital. We have a lot of guidance and support throughout this evaluation phase and through the funded phase. And actually, right now we are running a Christmas deal. So basically, we're splitting more profit. So instead of 50-50, what we usually do right now for Christmas deal, we are running a 70-30% split in the profit. So 70% to the trader, and we keep, as the firm, we keep 30% to ourselves. And you also have 45 days to pass the evaluation to reach the goal that we aim. For day traders, it's amazing because especially in the US, you need at least $25,000 to day trade, and we actually providing that with as little as $300.
Okay, that sounds good, Michael. Thank you very much, and Leslie as well. As far as Option Professor is concerned, we do have some PDF reports on how to hedge against market declines and upside surprises, which has been very helpful this year to people. And also we have a one-on-one review of the markets you own, and we give you our vantage point and our expertise on what you're holding. So just go to optionprofessor.com, put your information in, and we'll get that over to you. Again, Michael and Leslie, thank you very much. Have a great, happy holiday. Okay, guys?
Thanks so much.
Thank you. Happy
Merry
holidays,
Christmas,
everyone.
guys.
Yeah. Bye-bye.
Okay,
Bye.
and we'll talk to you soon. And this is going back to David now. David, back to you.
All right. Thanks, everyone. Great discussion today. A lot of good info. So please be sure to subscribe to Timing Research on YouTube and your favorite podcast app. Also, if you subscribe to, or if you have a Substack account, I do have the Timing Research updates on Substack now, so you can subscribe there, get updates on new events and everything. Just another channel to find out all about our, the info that we offer. So you can just search Substack on any, or search Timing Research on any of those platforms. And I just want to thank my guests again for today. Michael Katz of TradeThePool.com and Leslie Jouflas of TradingLiveOnline.com and the Option Professor of OptionProfessor.com. Thanks, everyone.
Thank you. Bye, David.
Thanks, guys. Bye.
Thanks.